Thank you, Gihanna. I'm very glad that David's going to be here to make sense of what I'm about to say. So good morning, everyone. So it's my job in the next 20 minutes to run through how we're seeing the outlook. So I'm quickly going to get onto my conclusions to start off with. So my number one conclusion is, as always, there are plenty of things to worry about. We have Trump, we have trade wars, we have Brexit, we have recession risks. We all know it's an old cycle. My guess is that the central bank easing that we've seen so far this year, and also the dialing down of the trade war risks, is pushing US recession risk out of 2020 and potentially into 2021 or even 2022. But the thing I think that we need to worry about the most, my number two conclusion, is that the return outlook for the next 5 or 10 years just doesn't look that great. And we know that because low interest rates tell us that it has to be true, because returns are ultimately anchored by the risk-free interest rate. And my third conclusion, and people who've heard me speak before will know this is the one that I always make, that if you're going to try and track the ups and downs of markets, it is absolutely essential to be guided by a really solid investment decision-making process. Now, what I want to do now is I want to run through a countdown of what I think are the top 5 investment strategy themes to be worrying about over the next year or so. So top of the list is recession watch. And we're all on recession watch right now, which isn't surprising given that it's over 10 years since we last saw a recession. And these things tend to happen around about once a decade. Now, recessions are obviously bad news because they always are accompanied by big equity bear markets. And the last 5 bear markets in the United States saw the S&P 500 down by an average of 43%. So this is the thing that has everyone worried right now. The yield curve, the spread between the 10-year Treasury yield and the 2-year Treasury yield. Now, last year, I put this chart up and I said that it was a pretty optimistic indicator because it hadn't inverted. The 10-year yield hadn't fallen below the short-term yield. This year, this is absolutely the most pessimistic indicator there is right now, because we've seen the 2-year yield, which I'm showing here, go briefly below the 10-year yield, but the 3-month yield has spent most of the year below the 10-year yield. Now, those grey bars up there are US recessions, and the yield curve has been the best predictor of recessions since at least 1960. And it's a powerful signal because an inversion of the yield curve when the 10-year yield goes below the short-term rate is telling us that investors think the outlook for growth is going to be so weak that it's going to force the US Federal Reserve to continue to ease monetary policy. Now, there's a couple of reasons why we might not want to get too panicked straight away, though, I think. I don't want to say this time is different, but there's a couple of reasons why we might not want to get panicked too far. And one is that this is a relatively mild inversion. And in some ways, it looks to me a little bit like what happened here back in the mid-1990s. If you cast your mind back to then, the Fed had been raising interest rates, and then the global economy got hit by a sequence of shocks. We had the Russian bond crisis, the Mexican bond crisis, the Asian economic crisis, and the collapse of long-term capital management. And as a result of that, the Fed cut interest rates by 3 times. Now, none of these shocks turned out to be nearly as damaging as a lot of people were worried about, and those 3 easings with the dialing down of those risks saw the economy then have a recovery in the subsequent year. And I think that it might be a bit similar this time with the trade war risk starting to be dialed down and with the Fed easing, and I think that might set the scene for a modest economic rebound over the first half of 2020. So we might have another mini cycle still to come before we hit that major cycle which is coming down the road. So my subjective probabilities on these are my subjective probabilities on what I think the potential outcomes would be. Now, we can't rule out the bear case scenario. You know, the yield curve tells us that's got to be a risk, and I would give the bear case scenario probably a 1 in 4, maybe a 1 in 3 probability. And there's also the risk that the damage that's happened so far from the trade war has done such a shock to global supply chains and global business confidence that it does send us into that recession that the yield curve is predicting. But I do think that the odds, at least in the near term, are tilting slightly towards a more positive outcome over the next 6 to 12 months. So we may have that final mini cycle before we do head for the major downturn, potentially in 2021 or 2022. Theme number 4, China-US tensions. So even though there are some good reasons with the US election coming up next year for thinking that we might see an easing in tensions between US and China, I think things are likely to get worse over the long term. And in global policy circles and in global think tanks, it's been very popular to start talking about the Thucydides trap. And this relates to the story of how the established power Sparta was overtaken by the rising power Athens. And historians say that this pattern is repeated time and time again over the centuries, and most recently we saw it with the Soviet Union and the US after World War II, and we saw it in the late 19th century with Germany and the United Kingdom. And it doesn't always end in military conflict, but what it does tell us is that the United States and China are likely to remain rivals for the long term. Now, the clash with China didn't start with Trump. It was already underway under President Obama. But I don't think this clash with China goes away even if Trump was to lose the election next year. And in fact, if Trump is replaced next year, Xi Jinping may look back fondly on his meetings with the Donald. Because Elizabeth Warren, if she becomes president, she's going to have a much greater focus on things like human rights and environmental protection. So the point is, I think this China-US story is here for the long term. So we're on this long-term downward trend in China-US relations, but it will have a cycle around it. And I think markets are really going to track a lot of that cycle in US-China relations from here on in. Theme number 3, new policy moves. And like no one needs reminding that the last few years have been an extraordinary time in our central banking. Now, I started my career as a central banker back in the early 1990s at the Reserve Bank of Australia. And when I was a central banker, we never even imagined that we would see things like quantitative easing or negative interest rates. And I think the next chapter of unconventional policy that we're all going to be hearing a little bit more about is a thing called MMT. And MMT stands for Modern Monetary Theory. And the basic idea of MMT is that low inflation and low interest rates mean that governments should be able to spend up as much as they like. The only constraint on how much governments can spend is inflation. Now, not surprisingly, MMT is a policy that's getting a lot of airplay on the left side of politics, particularly in the United States. So a couple of the big champions on the political side of MMT, one is Alexandria Ocasio-Cortez. Some of you might have heard of her. She's a 30-year-old Democrat congresswoman from New York, and she has this Green New Deal policy which has MMT as a big part of it. Bernie Sanders, his chief economic advisor is called Professor Stephanie Kelton, and she is one of the leading academic proponents of MMT. And over here, Jeremy Corbyn's idea of a people's quantitative easing, where the Bank of England would directly finance spending on public infrastructure, well, that comes straight out of the MMT playbook. So the underlying belief on MMT is that the private sector nowadays just is not able to generate enough demand to create inflation. And people who believe in MMT, well, they point to what's happened in Japan over the past 25 years and what's happened in the United States and Europe over the last 10 years, where we've had repeated rounds of quantitative easing and even negative interest rates just haven't been enough to generate inflation. So people who believe in MMT, they say, well, interest rates are going to stay low forever, therefore they're not particularly worried about rising government debt. They think that the only constraint on what governments can do should be inflation. So therefore, governments should be able to spend up when inflation is low, and they only have to cut back on spending when inflation starts to rise. And I think we can already start to see a number of the problems with MMT. The first problem is that, of course, politicians are going to love the first half of that bargain. This idea that they can spend up when inflation is low is going to be very, very appealing. But do we honestly believe that politicians will live up to the other half of the bargain and cut back on spending when inflation is particularly high? The second problem with MMT is, I think, and all of us who are involved in markets know this, it's really dangerous to believe that interest rates will stay low forever. We know that if markets lose confidence that the authorities have lost control of inflation, then interest rates can gap up very, very highly. And against the backdrop of high debt and high deficits, that's a great recipe for creating a fiscal crisis down the road. And the third problem with MMT is Zimbabwe, Venezuela, and 1930s Germany, which is why a lot of mainstream economists call MMT magic money tree theory. But it's important to know about MMT because what it tells us where the political shift debate is going. The political debate is going towards more government spending and higher debt levels, and we've seen this already. We saw it with the Trump tax cuts. We're seeing it play out in the current election where Boris Johnson is completely abandoning fiscal austerity. Now, big fiscal deficits and higher inflation will ultimately cause higher interest rates. I think that's a given. But we probably won't get there until after the next recession, because I think at the next recession, politicians will throw the proverbial fiscal kitchen sink at the downturn after monetary policy has run out of ammunition. So the key takeaway is that the debate is very much heading in policy circles towards higher spending, higher deficits, and higher government debt. My next theme is the long-term outlook for interest rates and what it tells us about investment returns. Now, I've pinched this idea of purgatory or hell from Ben Inker at the well-known value manager GMO that's based in Boston. And I think purgatory or hell really nicely sums up some of the scenarios that we're facing right now. Now, the biggest question in investing, I think, is the level of the long-term interest rate, because the long-term interest rate, it determines absolutely everything, or just about everything. It's the rate at which we discount the future. So obviously it matters for the value of our pension liabilities, but it also drives the outlook for investment returns, because investment returns are simply a premium over the risk-free rate. And that's why we talk about things like the equity risk premium and the credit risk premium. So it matters a lot whether we stay in this low interest rate world or whether interest rates go back to more normal levels. So I want to focus on this chart because I think it shows a really interesting long-term relationship. And what I've got here is the orange line shows the 5-year annualised growth in nominal GDP since 1960 for the UK economy, and the blue line shows the 10-year gilt yield. I could draw this chart using US GDP and US Treasury yields, and it would look almost the same. And you can see that the two tend to move together over time. And that's what economic theory tells us should be the case. And the logic behind that is that you can think of the government bond yield as sort of the cost of borrowing to invest in the economy, and the trend rate of nominal GDP growth as the return that you're going to get from that investment. And over time, we know that in equilibrium, the investment cost and the investment return should be roughly the same. So there's a force of gravity that pull those two lines together. Now, under the hell scenario, so getting back to my hell or purgatory metaphors, under the hell scenario, the orange line, so we've had this big gap here, the orange line will move lower to meet up with the blue line. And this is the secular stagnation view of the world. So anyone who's been following what the famous Harvard economist Larry Summers keeps on talking about, he keeps on talking about we're in this secular stagnation world. And under that world, poor demographics in the Western world, ageing populations, and weak productivity growth means that trend growth is very low. And that means that we're going to be staying in this low interest rates world for the foreseeable future. And that means, and it's going to be hellish for investors because it means a future of low returns. Now, I can probably hear people thinking that people like you economists have been standing up here for years telling us that we're heading into this low return world, and returns have actually been pretty good over the past few years, and that's right. But I think that's been part of transitioning to this low interest rate world. And let's use the example of equity markets. We value equity markets on the future stream of dividends that are going to be paid to us. And we use the long-term risk-free interest rate to calculate the net present value of those future dividends. Now, equity markets have gone up not because we've all suddenly become massively more optimistic about how much money companies are going to make in the future. They've gone up to a large extent because that low discount rate means that those future profits are more valuable to us today. Purgatory, on the other hand, purgatory means transition to another place. In this case, a world of higher risk-free interest rates and higher investment returns. But the problem with purgatory is that going through purgatory is going to be no fun at all, because that discount rate effect will have to go in reverse. So higher long-term interest rates means that those future profits are going to be less valuable to us today, which means we have to go through a transition to lower price to earnings ratios. Now, after purgatory, we're in that world of higher risk-free rates and better long-term returns. So I think purgatory makes more sense as a scenario than hell. So I don't think we're stuck in this long-term hell scenario. But I do think that interest rates are going to stay low for the foreseeable future. I think they stay low through this cycle, but once we get through the next recession, and then policies like MMT become popular and politicians start spending up, I think in the next recovery, that's when we start to see both higher inflation, higher interest rates, and that's when we transition back to this future of higher expected returns. And my final theme is one that unfortunately I can't avoid talking about. I have to do it, we're in London, we have to talk about Brexit. Now, there's no point, we all know there's no point making predictions about the election. Opinion polls haven't been much use recently. I think, as most people probably do, this election's going to finish with either a small Conservative majority or a hung parliament. But I do think is that one thing that has come through is that we're probably not heading towards a chaotic no-deal Brexit. So the main issue is, what does this mean for investment markets? So going through this election, I think we're either going to end up with a withdrawal agreement, or if we get a hung parliament, we may end up with a second referendum. So in terms of the implications for UK asset prices, the most obvious one is around sterling. Sterling still has upside. Sterling is the market that tries to price in the probability of Brexit outcomes. But if we're heading to either a withdrawal agreement or a second referendum, given that fair value for sterling on everyone's purchasing power parity, including our valuations, is around about 140 against the US dollar, sterling still has upside. I think the second implication is that the UK equity market, in a world of expensive equity markets, the UK equity market actually stands out as being relatively fairly valued to slightly cheap. I like the 5% dividend yield. I like the 12 times forward earnings. The problem, though, before getting too excited about UK equities, is that the FTSE 100, around about 80% of the earnings for companies in the FTSE 100 come from outside of the country. So the rising sterling is going to be a bit of a headwind, but I think the FTSE looks good for the medium term. And gilts, I think with the no-deal Brexit slowly coming off the table, I think gilts have seen their lows, but we have to put a big qualified probably around that, because if we do go through a global recession in 2021 or 2022, global long-term yields could test their lows again everywhere else in the world. But that shift towards fiscal irresponsibility that we're likely to see going through the next recession, I think, means that yields should trend higher after the next downturn. So here are my key takeaways then. So there is plenty to worry about. There's always plenty to worry about, but this time we've got Brexit, we've got Trump, we've got trade wars, we've got the fact that it's the second longest equity bull market on record, the fact that around about 30% of global government bonds are trading at negative yields. So there are plenty of reasons why you would want to be cautious in your portfolio positioning right now. But I do think that the central bank easing that we've seen so far this year, the dialing down of the trade war risks is pushing those recession views out of 2020 where we thought it might be and into 2021 or even 2022. But even if my glass half full outlook is correct, one thing I do know is that the equity market upside is still at this late stage of the cycle much smaller than the potential downside. And if we do get a recession-generated bear market, it is reasonable to expect a global equity drawdown of somewhere in the order of 35% to 45%. Number two, the return outlook just doesn't look good for the next 5 to 10 years. And we know that because low interest rates right now tell us that has to be so. Returns are anchored by the risk-free rate. So a big question is, are low interest rates permanent or temporary? Are we in this world of secular stagnation and permanently low growth, which means permanently low interest rates? I don't think so. But I don't think we're going to fully break out of this world until we get through the next downturn and we see that shift to more aggressive fiscal spending and things like MMT might become popular. And my third point is the one that I always make at these sessions, is that you really do need a good process when you're trying to navigate the ups and downs in markets. And think about the past 18 months. I remember last year, heading into September, global equities were up around about 15%. Our cycle value and sentiment process had been making us cautious. We were getting a lot of questions as to why we weren't buying more into the rally. And then we know what happened late last year. The equity market fell, the US market fell nearly 20% up to Christmas Eve. We were adding risks into that environment because cycle value and sentiment were telling us that markets had overreacted. It's the same story again this year, with markets having rallied 25%. Our process is keeping us a little bit cautious through that rally. So the key point is that a clear and simple investment process like cycle, value and sentiment helps us step away from the market noise and get a clearer picture of the risks around markets. So it helps us avoid the really big mistakes. And remember, the two really big mistakes in dynamic management are getting bullish at the top of the market when everyone's euphoric and capitulating like last December when everyone's completely panicked. Thank you very much.
I've been told I should speak out in the middle of the stage and wander around. But I've been running money for about 20 years, and I've done lots of these presentations. You would be surprised at how many people fall off the stage. We're being live streamed today, and I've always wanted to be famous, but I don't want to be on social media as the guy who plummeted onto the first row. So I am going to stay relatively static here. So, as always, Andrew has outlined the problems, and then I'm tasked with finding the solutions, or at the very least, a navigatable way through. I'm going to talk about uncertainty, because we always live with it. But we're going to talk about how we deal with that uncertainty and how we think about it. I'll then talk about diversification and somewhat the truth versus the reality. I'll follow on from Andrew's thought piece about that risk-free rate that you saw anchored at those low levels and look at what role, if any, government bonds can play in your portfolios. I'll then begin to provide a view around what we do given that uncertain outlook and provide some pragmatic solutions as we see it. And we'll look at some options one can put into your portfolio. And finally, we'll culminate in showing you one of our portfolios today that is the unfettered, unconstrained, so you can see the risk and return trade-offs within that portfolio absent the benchmark, so where our true conviction lies. So what to do with Andrew's outlook? And this is how I often feel. Risk one side, return the other. Totting up those probabilistic outcomes that Andrew gave you, it does give you a positive outlook. 2 of the 3 were pretty positive, albeit one moderately positive. But a 20 to 30% chance of a recession and an accompanying 30 to 45% drawdown isn't something you should dismiss. And pardon the pun, but it does certainly keep you on your toes. However, it's also true that uncertainty always exists. We don't have a perfect forecasting mechanism. We don't have a crystal ball. When President Trump announced his candidature, He was 250 to 1 and a reality TV star. He now looks likely to potentially get a second term as president. We always have to deal with uncertainty. And it's not like we haven't been here recently. Lots of the issues Andrew mentioned, we had in 2018. Almost exactly the same type of issues we had in 2018, and we had to deal with that. So uncertainty is something you always have to deal with. I see our job as an investment team not to predict the outcome of future events, but to calculate the probabilities of those events occurring, and more importantly, to ascertain the impact on markets if those events do occur. Markets are a discounting machine, as Andrew mentioned. They discount future events into today's prices. So what we can do is try and judge what is already priced into markets. Because if those risks are already priced in, or at least priced in to an extent that gives a higher probability than we think is realistic, then arguably you can step back into the markets and buy those risk positions. So uncertainty always exists. And our role is really to judge what is priced in. It's why we were able to buy risk in Q4, because as those risks started to manifest themselves, the market was always looking forward and discounting that steep decline in markets, and it enabled us to buy risk assets. Now, last year we talked a lot, and I do mean a lot, about the risk of losing money, which is clearly a much more obvious risk. But there's also the risk of not generating the required rate of return that's necessary for clients. And I know I have a penchant for talking about risks and negatives, and I rather see it as my job to concern myself with those risks because we're managing money on behalf of clients. I also feel it's my job to talk to trustees and clients about those risks so that they know that the risks that they are taking in order to achieve their objective. In my limited experience, nobody minds an upside surprise to markets and to returns. They're a lot more concerned about the downside surprises, about the risks that weren't alluded to. As such, I think often, certainly Andrew and I, we work together every day, and we thinking about risks every day can appear extraordinarily cautious when we speak from the stage. And I'm sure we did last year. Andrew talked about those risks. I talked about the risks of losing money. Well, it does feel like a distant memory, but Andrew said markets did fall 20% peak to trough over that period. It feels a long time ago now because we've had such a bounce back. But during that risk-off period, the process that Andrew talked about enabled us in all of the portfolios that we have control over to add back to risk positions. So whilst we can sound very cautious from the stage, our actions are sometimes very different if those risks are priced in. It's why our process isn't static. As the odds and the magnitude of events risk change, our process, we think, keeps us navigating through what we think will probably be continually choppy markets, and it will allow us to keep our head in slightly darker days and hopefully keep our wits about us when the market is a little more optimistic, as it's been certainly over the summer. But the point is that uncertainty will always plague markets. It's always been the case. And it's something we just have to continually deal with. But it isn't about just being dynamic with your portfolio. It's about building an appropriate base portfolio to start with. I would like to think that there isn't anyone here who doesn't believe in the principle of diversification. In my very formative years, when I was much younger and had brown hair, I met someone called Harry Markowitz, who some of you may have heard of. And when he was questioned by essentially my graduating class about his seminal work, he pulled out his Nobel Prize, plonked it on the table, and said, "Here's mine, where's yours?" And for a guy who was about 80, it really was a drop the mic argument one type of moment and put us firmly in our place. Now, for those of you who don't know Harry Markowitz, he's the founder, really, of modern portfolio theory, which is a theoretical framework for the analysis of risk and return and their interrelationships. And he used statistical analysis for the measurement of risk and the mathematical programming for the selection of assets. Essentially, his concept, his work led to efficient portfolios that most of our portfolios today are based on. Now, he emphasized really that the quality of a portfolio is different from the quality of the individual assets within it. He said that the combined risk of two assets taken separately is not the same as those two assets put together. Now, it really was seminal work, and it's still used today. But in his model, you need to input expected return, risk as measured by standard deviation. That's difficult enough. But you also need to plug in a covariance matrix. So look at the covariance between the returns of the assets you're considering. Covariance is how assets kind of interact with each other, and it is notoriously unstable, particularly in the short term. It's that covariance assumption that can cause issues in the real world, as whilst asset classes might be diversified, they have one thing in common: us, investors. That is the commonality. Human behavior is the commonality. You multiply that by leveraging the system, and it becomes a little unpleasant. As we've discussed before, investors, retail, institutional, portfolio managers tend to yank money out of markets as they decline, and reflexivity kicks in, and selling begets selling. So you start with diversified portfolios, but us as investors create a different world where asset class correlate together and start moving to one. Now, there's another person I'd like to introduce you to, and it's a chap called Yogi Berra. I have to be very careful how I say that. Yogi Berra, not Yogi Bear, clearly. I'm not a baseball fan, but he's a baseballer. He's a Yankee. He's a Hall of Famer. And he said, in theory, there is no difference between theory and practice. In practice, there is. So let me say that again. That's a tongue twister. In theory, there is no difference between theory and practice, but in practice, there is. So the things you learn in the classroom, it doesn't quite pan out like that in the real world. And 2008, 2001, 2011 episodes that we've seen of market weakness have really borne that out, because diversification is a little more hard to come by when assets are being withdrawn and leverage is being sucked out of the system. Now, the reason that's more of an issue perhaps today than it has been historically is because the way the financial system has moved on. So lots of pension funds now are cash flow negative in that they are using their pensions pot to start to pay their beneficiaries or start to pay transfer values. Retail clients, following the kind of Pensions Freedom Act, rely now much more on their investment pot and less on annuities to fund their lifestyle. So you have a whole cohort of investors who are now regularly taking money out of their portfolios. And as we showed you last year, and as I'm sure you're aware, at some stage you have to take money out if you need it from a market that might be a little less opportune. In that instance, that is permanently destructive to your portfolio, because taking money out never has the chance to bounce back. So again, it goes back to that Yogi Berra quote that diversification is good, it's solid, but it can't be always relied on when you need it most. It doesn't mean you shouldn't have diversification, and we are certainly not dismissing it. We just think that you need to start with an appropriate portfolio that is diversified, but you do need to take a pragmatic approach. You should stress test your portfolios for all different types of scenarios, including the ones that us as investors create. And ultimately, we think you should diversify, but with conviction, with deliberance. So let's look at some examples. Here's a chart of an asset class we have in our portfolios today. And whilst it rolls across the screen, I'll ask you to just have a think as to what this might be. It's certainly volatile. There's been opportunities to make and lose, quite frankly, quite a lot of money in this asset class. It's a US 30-year government bond. When I first pulled up this chart, to me it looked a lot more like an equity market, because bonds have become more volatile. Now, we own this in a lot of our portfolios, even though our long-term forecasts suggest the real return on government bonds is either negative or very, very anemic. So why? Why do we own it when, as Andrew showed you, yields are at all-time levels and we think they might have bottomed? Why own it when we have it in portfolios where we don't have to, in growth portfolios, in portfolios where we don't have a benchmark where we have to slavishly fill that allocation? Well, we own it because we do believe in diversification. And we had a short to medium term view earlier in the year that bonds may rally on further interest rate cuts. They would rally if the economic situation continued to deteriorate, and it would rally if any of those event risks that Andrew talked about came to fruition. Well, they did. Some of those things did come to fruition. Economic data did deteriorate. So we added, not at the bottom, sadly, but certainly midway through the year. And at this stage, equity markets were at all-time highs. What that essentially allowed us to do is diversify the growth portfolio a little bit more, put some ballast in the portfolio, immunize us somewhat for the drawdowns that then happened over the summer, and all without cutting risk. Because as Andrew said, our base case is that markets still continue ahead. So that would have been the other option, take risk assets out. But we are working on probabilities and an uncertain future. This felt like a much better way in the short to medium term just to immunize us from A, being wrong, but from B, suffering from some of the drawdowns. And so putting that into the portfolio, that bounce we saw, which is pretty aggressive, that's a 20-year bond, 30-year bond, up something like 17% in the space of 4 or 5 weeks. That really helped secure us portfolio and meant that I didn't panic and have to cut equities as the world started to look a little unpleasant as Trump started tweeting every Sunday night, so that Monday mornings were a bit of a pain. I guess the so what here is you should diversify, but timing is still necessary. Buying at the wrong point at any one point in this graph would have lessened the benefit of having diversification in the portfolio. And so I think it's a marrying of these long-term strategic forecasts and the academic work of someone like Harry Markowitz, plus a process that allows us to enter, hopefully at the right time, which will be the arbiter of success and the way we can navigate markets going forward. So diversify with conviction, but also smartly. So what else do we have in the portfolio to act as that counterbalance? How are we diversifying with conviction? What is allowing us to carry the equity risk we need to hit our return targets? Well, today, by and large, it is the Japanese yen. It is some degree of equity protection. It's bonds, I've just mentioned, and it's cash. We have thus far this year managed to balance it such that it hasn't really been a drag to performance, except arguably the cash balance, which have accrued over the last 2 or 3 months, really, as equity markets have started to look a little frothy. So we discussed the Treasury position, but what we didn't suggest, or we didn't note, is because it's a 30-year bond, we actually only put a 3% position in the portfolio. Now, this is some really crude maths that I wouldn't want my economics lecturer to hear me talk about, but a 3% position in a 30-year bond is the equivalent of a 10% position in a 10-year bond. So when we think about allocating, we want to have a duration impact. We don't think about things as an allocation weight. So we think about it in a much more efficient manner. That meant that extra 7% I could sit there in cash. Now, cash doesn't go up, sadly, in a crisis. In fact, if anything, it goes down a little bit as interest rates come down. But it certainly doesn't go down a whole lot like other asset classes. And cash gives you that dry powder that enables you to add back to risk assets, as we did last Q4, if markets weaken. So cash, people say cash is king. I'm not quite sure about that, but it definitely gives you flexibility and is a good part of a portfolio diversification. The other thing we have big positions in is the Japanese yen. As you're probably aware, it has a good reaction to risk-off scenarios. So essentially, almost every time the market goes down, the Japanese yen goes up. Now, the corollary of that, you would have thought, is that when you have good times, the Japanese yen should go down. It should be a seesaw, largely speaking. Well, that's right, definitely. However, because the yen today is cheap, we believe its downside, even in good times, is much more limited. If you buy something that is cheap, whatever it is, its downside should be limited by that valuation. So we think the upside is a lot stronger in a downside scenario, and it won't lose as much, actually, if the world turns out to be a very nice place. So that kind of asymmetry is always interesting to us in portfolios. I guess the key here is, whilst we're talking about risk mitigation methods, we aren't running for the hills, we aren't cutting equities back. We do believe that equities and risk assets moderately trend upside from here, as you saw in Andrew's central scenario, and we don't want to miss that. But these techniques and these assets ensure we can still carry that amount of risk assets in order that we can hit our return targets, but also so we aren't so exposed to a 2018 where 97% of all asset classes ended in negative territory. And there's also a bit of candidity there that we might be wrong, or that Trump might press the wrong red button one Sunday when he wakes up, and the world might change. So you always have to hedge against that uncertainty. What we're trying to do here is have a balancing act so that we can have the risk assets that's necessary to hit the return without having all of one's eggs in the same basket. So we think you should diversify, but with cheap assets. You should be precise as to how you're diversifying. Be purposeful. And clearly we believe that cash provides that flexibility. So what other options do we have? If I can, there we go. And this is a very bad pun. So the other options we have are options. Clearly I am turning to my dad. Now we buried portfolios, we buried these call options into our portfolios last May. So we have a European stock market call option in our portfolios. This instrument gives us the right to buy the European equity market at a level of 3,550. The market today, or at least it was this morning, was 3,700. This option lasts until next Christmas. So if equity markets continue to rally, let's say the European equity market goes up another 10% and gets to 4,000, I can buy that, use this option to buy the market at 3,550, sell it immediately at 4,000 and bank a profit. That sounds like a no-brainer. And when we talk about this quite often, we get asked why we don't do this more regularly in the portfolio. Well, the problem is it's usually very expensive to do that. There is no such thing as a free lunch. Giving you optionality is expensive. But last May, for a number of technical reasons, that option was very, very cheap. And so we embedded it in our portfolio. Now, I realize lots of you perhaps had a later night last night. I know I was out with dinner with some of you until 9 or 10, but I understand some of you went a little later. So that was a technical description of what I've done in portfolios. This is the visual one to make it a little easier without being teaching you to suck eggs. As the equity market goes up, that option grows in value, grows in size, becomes more valuable. It really is that simple. Now, if markets go down, the premium we paid will be lost. Will be lost. But the other option is to have just bought the equity market where the downside is then unlimited. Unlimited upside, unlimited downside. With the call option, it is limited downside, limited to that relatively cheap option premium, and the upside is unlimited. So again, it's the right type of asymmetry. We can deploy this in our portfolio without leveraging portfolios because of that cash balance. So again, that cash balance comes into play and backs some of the derivatives we have in the portfolio. Now, this is a slightly different example than the other ones, but it's still hedging. But here we are hedging against an upside surprise. And we're doing so in what I believe is a much more risk-adjusted manner. So here is the portfolio as it stands today. You can see, hopefully, the government bond element at the top right in kind of dark blue. The cash balance as at the end of September was 9.4. That's actually a little lower today because the markets have wobbled and we've started to put some money more back to work. You can't see the yen because that is an overlay to the portfolio. And if I just grey out those kind of more risk-off assets, you can still see that we have pretty healthy levels of risk in the portfolio. So about 40-ish% in equities. That's more than we had when I spoke to you at the same time last year. Because as I said, we added in Q4 and have benefited from that bounce back. Plus, that option I talked about, the balloon isn't fully blown up, but it's starting to get more valuable. So the equities have actually drifted up a little bit in the portfolio. This portfolio, as of yesterday, was up about 11.5%. So I don't want anyone to come away with the fact that, or the impression, that for all Andrew and I's talk about risks, we've been too overly cautious. But the use of diversification and our process, which enabled us to add back to equities in Q4, use that optionality. embedding some of those bond instruments in the portfolio, have meant that the level of return we have achieved today has been achieved at a relatively low level of volatility. So the portfolio is currently printing at a volatility level of around 4.5, the same as US government bonds. Now, clearly, it is not the same as US government bonds, I would say, but that is the benefit of diversification and the environment we're in. A probably more truer measure is we're printing at about 40% of the volatility of an equity market. And yet we've managed to create a reasonably healthy return through a combination of assets, through managing through the cycle, and through embedding those protective elements in the portfolio. To be completely candid, all of this has been good, but with full hindsight, and with that crystal ball, I should have just put all the money in equities. And we would have got a jolly healthy return, clearly. I'm not advising, clearly, anyone does that. I think that the journey there is completely tumultuous and ends in a bad place. But again, I want to be candid that 11.5 is a good return, but equities are up a little bit more this year. But building a diversified portfolio, particularly for those investors where money is coming out, is a much more sensible way to run money. Essentially, as Andrew alluded to, there are lots of risks out there, and there are lots that we don't know that are out there. We're late in the cycle, so our job really is to achieve the return that our clients need, but at the risk level that they can survive. So my key takeaways: we always live with uncertainty. We talk about it a lot, but it is always there. It's there in the good times, it's there in the bad times. Risks exist both to the upside and to the downside, despite us often focusing on the downside. And for me, success really hinges on two things: the interplay between long-term strategic diversification and shorter-term flexibility. A marriage of those two factors, I think, is what is going to drive successful investing over the years to come. And our simple takeaway, my simple takeaway, is purposeful diversification is the way forward. Thank you very much.